Can I ask for 5 minutes?
Thank you, Mr. Chairman. Chairman Bernanke, sometime earlier you and I had a conversation, and I asked you the question about why the United States was doing relatively better than its neighbors across the seas and others, and you said, well, it's because we have the best-looking horse in the glue factory. I'm wondering where that horse is now. Is our horse still in the glue factory? Is he in the pasture just outside the glue factory, or is he back on the farm?
Well, it's clearly the case that we're not yet where we want to be. We have 7.5% unemployment. We have very low ratio of employment to population. A lot of people leaving the labor force. GDP growth has exceeded now where we were before the crisis, but we're still well below the trend of growth. That being said, I was struck by at the latest meetings of the IMF and the G20 in Washington recently, when the IMF economists were talking about a 3-speed global recovery, by which they meant the fastest growth still taking place in some of the emerging markets like China, but the United States now breaking away to some extent from the pack, notably from Europe and Japan. And we have had better performance. In the case of Europe, it was about less than 4 years ago that the U.S. and the Euro area had the same unemployment rate. Today, our unemployment rate is 7.5, and the European unemployment rate is above 12. So we really have done better than some other countries for a variety of reasons, not just monetary policy or any single factor. But we are moving in the right direction. But I don't think we can be yet satisfied, given where the labor market is, and given that we still have unused capacity in this economy.
You cautioned in your statement that too much restraint too quickly continues to be the headwind that we may not want to get into, but we haven't addressed our longer-term problems. And then you mentioned that you thought the 10-year window might be too short to do that. Some of us are looking now at something like more than 30 years relative to where our growth will be relative to our debt. And particularly the enormous spike in mandatory spending and the impact of that on interest rates and the economy and so forth. You have suggested before that you've used a lot of the tools, most of the tools that the Fed has to get us through this period of time, but ultimately that responsibility falls here and with the administration. And we have yet to, I think, summon the political will to address that long-term problem. My take is that that begins in earnest in a relatively short period of time, maybe 2 or 3 or 4 years. And so to me, it would make sense that we begin to address it now. Chairman Klobuchar mentioned some of that earlier on. Could you expand a little bit more on that about what you think our responsibility is? Because I'm starting to hear things like the Fed is buying us time, so therefore we don't need to take action right now. Is the Fed being an enabler for an addiction that Congress can't overcome?
Well, the Fed is doing what Congress told it to do, which is we're doing our best to try and promote maximum employment and price stability. Congress needs to take a longer view. It's true that interest rates are quite low today, and therefore the interest burden today is quite low. But when the CBO scores budget plans out for a decade or 2 decades, it assumes that interest rates are going to rise, which we hope they will, because that'll be a suggestion that the economy is recovering and coming back to normal. So in looking at those 5 and 10 and 20-year budget plans, they assume higher interest rates, and you're going to have to deal with higher interest rates at some point, we hope, as the economy strengthens. And so I very much support your suggestion of having a longer horizon. I would note the 1983 or whatever it was Social Security Commission that my predecessor chaired, that the reforms that were introduced then are still now being phased in, so 30 years later. So for some of these changes, very long lead times are make it much easier to achieve.
And lastly, your concern about the low amount of interest return and the risk-taking or the reaching for yield. Is this creating another potential bubble? There's a big surge in the market here that seems to be not enforced by underlying fundamentals, but I'd like your take on that.
Well, we're watching it carefully, and of course, nobody can ever say with certainty what an asset price should be. But to this point, our sense is that major asset prices like stock prices and corporate bond prices are not inconsistent with the fundamentals. For example, it was mentioned earlier that price-earnings ratios and the like are fairly normal in the stock market. In addition, in thinking about risk to financial stability, you also have to look at things like leverage, credit growth, and other indicators that suggest not only is there some mispricing going on, but that mispricing has the possibility of greatly damaging the broader financial system, and we're not seeing that to this point. So at this point, of course, it's always, again, dangerous to predict, but our sense is that those issues are still relatively modest, but they require very close attention, and we will continue to do that.
We're glad you're doing that because we don't want a repeat of what happened before.
Absolutely not.
Thank you, Mr. Chairman.